Hi, I'm Dave Boike from Retirement Resources, and today we're going to talk about how do insurance companies make money. Well, it really boils down to numbers, folks. Insurance companies came into existence many years ago as people saw the need to insure some type of risk, whether it would be their farm if the farm burnt down and they needed to rebuild it, whether it would be benefits to a wife who lost her husband at war. Maybe it would be for a family that if the breadwinner passed away, there would be money available to help get the kids through school and raised and possibly through college. So what these companies did is they offered to first put together a group or a pool of people. Let's call it an association. And basically, they would bring these people together, say 100 people, and they would each pay in a certain amount of money. Obviously, the older that they were and the closer they were to potentially using that benefit, in other words, dying, the higher the premium would be. The younger a person was, theoretically, the longer that person would have to pay into this pool, and so their premium would be substantially different and much less than the older person, because chances are they were not going to pass away till much later in life. These are all called mortality studies, and they have people at the companies that have been gathering this data and this information for years and decades, and so they're getting pretty good with their numbers. They know approximately out of any group of 100 how many people are going to die at what specific age, and they call those mortality studies. And so insurance companies bank on the fact that the people that become their clients and decide to join their association are going to stay healthy for many years, in fact, outlive their mortality. And that's exactly what we've seen here in the last 10 years or so. Folks are living longer and longer due to modern medicine, due to better advice from physicians and other healthcare practitioners. People are living longer. For instance, my grandmother lived to almost 101. My grandpa on the other side lived to 93. So those insurance companies had an opportunity to collect premiums many more years than normal. Say an average individual typically lives into their mid-70s, maybe 78. The individual that lives to 80 or 90, of course, that is more profit for the insurance company. And then above and beyond that, the insurance company takes that money, they invest some of it in very safe, secure things like government bonds, CDs, collaterally backed mortgages, and they loan some money back out to the policyholders. Again, thank you for spending time with us today. I'm Dave Boike from Retirement Resources.